In this module, traders, we're going to be talking about the low-hanging fruit trend continuation trade. So the low-hanging fruit trade is what I consider to be sort of the bread and butter trade. It's the market's already moved. So for me, trading the U.S. session, we may have a market that's moved in Europe-London window from the high of the day, or perhaps Asia's put in a high and London's broken down and then dropped, and it's a trending day, or coming out of a first green day, whatever that may be, but it's a trending day, and it's a trade setup where all we need to do is let the market put in a peak formation, stop hunt, a pullback into the trend, whatever that is, for the easy continuation move back through the low of the day or the high of the day. So we're going to get very specific about this so that we can have confidence about entering into the move. But also very specific in terms of putting levels on the chart to understand with levels and time how the market will pull back for 30 to 45 minutes. Maybe in a really strong move, it may only be a one bar pullback. It might be a really strong moving market and it only counter trends for 15 minutes. But typically it'll be 15 to 30 minutes minimum. And there may be a 15-minute consolidation and then the continuation, so 15 to 30 to 45 minutes. But we'll have a very concrete method for entering into this trade. So again, my goal is to look for easy, high probability trade setups. So each time when I come to the screen and I scroll through the pairs, I always ask myself, if I have interest in trading something, what is my setup on this? What is my setup going to be? And so out of this playbook, there's always going to be one instrument that's going to give me my thesis for at least one good trade setup, and then obviously it just has to eventuate. But the low-hanging fruit is the trend continuation trade. Some days this may be the easiest, cleanest, and simplest trade setup in my session. So what that means is you're going to come to the screen sometimes and there just may be nothing really, maybe markets have stretched out too far, there's been lots of volatility, or they're, you're looking for the obvious easy trade. You take one trade and you get off the screen. You don't sit around for hours trying to trade and figure out where it's going to go, or get into something that's not even moving, or chasing something that's moving as opposed to a trend. Making sure, though, there is no major red news scheduled on the calendar. I do not trade any of these setups if there's major red news. The only major red news trade that I will take is first bounce, and there needs to be a setup on that day to take the first bounce trade, which we talk about in the first bounce entry section. So as you can see, we have a market that's broken down. Just obviously this PDF, don't worry, you've got these screenshots in your PDF folder, but we're going to go through some very specific examples. What I'm going to just demonstrate is we're going to have naked charts, and we're just going to measure the distance from low to high for a down move. And if we're trading in an upward direction from the high to low, we're going to have projected strike zones, specific measurements, and then timing into our window, we will have our opportunity for the entry. Noting no major red news on the calendar in the session that you're going to be trading. So for me, the U.S., I want to make sure there are no major red news announcements, because we could get into what we perceive as a trend and then boom, there's a 50 pip spike into our supposed trend. So we're looking for sessions where there is no major news. We want to see an already broken down market or broken out market in a previous session that's moving and trending. So typically that will be a market that's already coming out of a first red day setup, or we have broken a boundary at high of the week, low of the week, and it's reversing and trading to the other previous day's high or low. So it's broken one boundary, and the thesis is that they've triggered breakout traders and reversed, and now they're going to the other side. The trade setup in the session is a pump and dump for selling, or a dump and pump for buying. So again, going back to that example, we're in we're a broken down market. They've pumped it up to dump it back in continuation with the trend. So that's the pump and dump for selling. If we're buying, we're looking for the dump and pump. We're using our 15-minute charts for the setup, our 5-minute chart for entry with a close back inside of the EMA. So obviously this is a 15-minute chart, but demonstrating the market broke outside of the 20 EMA on the 15-minute before breaking back down and closing inside. Our 5-minute will just give us a tighter entry, a tighter stop loss, and for traders who don't want to go to the 1 minute chart just yet, that's a bit more advanced. Getting this thesis down and just being able to use the 5 minute with the 20 EMA removes analysis paralysis. We already have our thesis and the trade set up. Now we're just waiting for that market to pop up and then come back inside after we've moved 25 to 50 pips in against the trade. Now, in a more volatile instrument, gold, oil, those movements may be 75 to 100 pips, and we'll look at the specific examples of that as well. But again, coming back to our entry, it won't matter because until this 5 minute chart comes back inside, we're not getting into the trade anyways. Our stop loss will be a maximum, again, of 20 pips. Now, typically on the currencies, we'll most likely be able to get a tighter stop loss than that, a 15 pip stop loss. Oil, gold, probably still around 20 pips, 20 to 25, and index is the same, unless there's a real amount of volatility. But again, we're not trading when there's major news on the calendar. We're just looking for normal market conditions for the trend continuation. When there is no news on the schedule, there is no reason why there should be any unforeseen volatility. So you should have the confidence to enter the trade in a normal trending environment. Like any of the trade setups, whenever there's no major red news on the calendar, there should be the thesis should play out because there is nothing unexpected to come into the market to create all that volatility, and they maybe not have manipulated that market on the day, trying to consolidate volume heading into a news release. Our profit target will, in most instances, be a minimum of 50 pips. We'll put this in brackets. 25 would be, maybe if you're trading down low, which we're not. We're going to look at some different examples of when you've been brought down really low on the third level, that you may get a continuation into the low of the day or into the high of the day. But those are rare. We're looking for normal trends back to the other side. If the market's broken out, again, that's where we want to be paying attention to if we're at the low or high of the week, because we could be getting trapped now trading into the low or to the high. There's a specific difference in how these will set up. So these can be 25 to 50 pips on a scalp, but in a strongly moving market, if we are still inside of a high and low and we're moving to one side, they could certainly be 100 pips or greater, especially on gold, oil, and the indexes. The market, in most cases, won't just trade to the boundary, it will trade through the boundary. So we'll often, if they're going to continue moving a market, they'll put, 25, 50, maybe 75 pips into a market, into a trader who's trying to buy the low of the day or sell the high of the day. It will vary for different instruments. We'll go through some very specific examples. I would expect a 15 to 30 minute pump up. Again, can take a little bit longer. It could be 30 to 45 minutes. But in a trending market, we won't usually see that go for too long. But again, each market will be different. Sometimes it may be the full 45 minutes. But again, we're not trading when there's major red news, so we're looking for normal conditions. 25 to 50 pips into the trend. On rare occasions, it may go 75. But if it's a trending market, typically it'll probably just go to 50. So we want to see that. The market will then confirm our entry by pulling back inside. There's our peak formation for the trend continuation trade. If the market is moving down, we're going to measure 25 and 50 pips away above the low of the day. So in this particular chart example, if we measured up 50 pips, the market extended beyond that and went to the next quarter level, but we also, if we have a high or low that's just beyond that level, we redraw the box at that high and low. We just want to know where our 50 pip box is. If we're targeting, 50 or 100 pips, we want to know where our strike zone potentially could be. But if there is a high or low there, we will redraw that high or low, because the market, that is our new level, especially if it's beyond that, that is our new level for the market to trade to hit stops, trigger breakouts, and then reverse. Same thing on the downside. That's our strike zone. That's our strike zone for where we can look for the market to potentially reverse and start the reversal process. Doesn't mean we're getting in there. That's just we're looking for the market and how it behaves at that level, and then regain the 20 EMA for our entry and our max stop loss placement. We'll also show how to target potential measured move targets for taking profits. So once that happens, that's our peak formation into the trend before resuming the move. So it's essentially just a trend trade, and in some cases we'll have a market that's already reversed and it's starting its trend into our session, and the low-hanging fruit is just the easy trend continuation through the high of the day or the low of the day. Some are going to be continuation moves. We'll have the stop hunt process or the pullback process begin prior to the market open, and then the continuation trade into the open of the new session. There will be different variations of that, but we're going to look at specific examples of that in the next module and how to measure.